welcome back to Strong Man Personal Finance. If you're interested in a pair of delicious cargo pants that have durability, utility, and are comfortable, check out sprytack.com. That is my sponsor, sprytack.com. Now, we're going to talk about earnings today. We're going to talk about Honest My Bonest, because we all know Jeremy Lafifi, who smells like pee-pee. He's the guy that's all into this company. And why does he like Honest? Jessica Alba. It's like clean or something, and millennials are going to buy more expensive diapers because they're liberal or something like that. That's basically his theory. But as an accountant, I like to look at fundamentals. I don't care about, the stock's going to 10x and here's where it's going to be in 10 years. I want to see what the company's doing right now. I want to see what they've done historically, and I'll make my judgment based on that of whether I want to invest in this stock. So we're going to go check out Honest's Q2 earnings, and we're going to see what happened. So here's their news release. And actually, let's pull up Honest stock and see if it mooned. Did it moon? All right, it's up, 4% in the last 5 days, 15% in the last month, down 31% in the last 6 months, down 52% over the last year to date, and down 72% over the last year. Oh, God. Total return, negative 80%. So we can obviously see why Jeremy likes this stock, because he likes to buy stocks that just plummet. $362 million market cap. Okay. Revenue exceeds expectations. Revenue by revenue. Growth initiatives remain on track. Second quarter revenue growth of 5%. I guess that's year over year. Led by a 9% increase in diapers and wipes. Now, when I look at this company, it's just weird to me that this is supposed to be like a small company that's, breaking into this new exciting space where they're going to, change and disrupt the diaper industry by making clean, liberal, and amazing diapers, and they're only growing at 9%. I don't know. That doesn't seem that great, okay? Because this looks like this is like one of their core products is diapers and wipes, and they're only up 9%. Okay, maintain full 2022 revenue outlook reflecting mid-single digit growth for the remainder of the year. Wow. Okay, let's go ahead and look at the results. So what they have here is a comparison between 2022, this most recent earnings, and 2021, which was last year, the first 3 months of ending in June 30th. So we can see diapers and wipes revenue is up 9%. Wow, that's some crazy growth. Skin and personal care. Did I remember Jeremy saying that this is like their highest margin, or this is like a high margin category? Down 2%. And this is their core products are only up 5%. And then household and wellness is up 15%. Wow. Pretty freaking amazing, okay? So let's keep going down. Revenue by channel. So I guess their sales, either digitally or through retailers, is roughly split 50-50. And it looks like they're slowly increasing their percentage of their total sales that come from digital orders as opposed to retail. But it's roughly 50-50, and it really hasn't changed that much. Digital revenue increased by 9%, primarily driven by strong orders from a key digital partner ahead of a national promotional event. Sounds like kind of a one-time thing. In comparison to the prior year reduction of inventory by the same key digital partner. I wonder who that is, okay? And then we got, so that looks like it could just be a one-time thing. And if that partner doesn't do this next year, might have issues with revenue. Retail revenue increased 2% increased 2% due to strong performance in tracked channels. Wow, that's amazing. Gross margin was 30% in the second quarter of 2022 compared to 36% in the second quarter of 2021. That's not good. A big thing about what will make this company succeed in the long run is if they can keep decent gross margins. You compare this to like Tattooed Chef, right? Tattooed Chef has, what was their last gross margin? Like 1%? That's at the top of the income statement. 30% gross margin, 36% gross margin, and you should compare this to the industry. It's better than Tattooed Chefs, I'll give it that, okay? The decline in gross margin was driven by elevated raw material and inbound freight costs, as well as a high level of trade spent to support retail distribution expansion. Gross margin was also impacted by a one-time transition cost related to a fulfillment center cost savings initiatives. I wonder how much of an effect that actually had. Operating expenses were down roughly $12 million. That's good. Selling general administrative expenses were lower, primarily due to a non-recurring IPO-related expense. That's good. And their marketing investment remained above 15% of sales. Woo! Net loss, $10 million compared to $20 million in the second quarter. So let's go down and see. Let's go look at the financial statements. I think they have them. They have, of course, they're at the bottom down here. So what's the first thing I noticed? For the 6 months ended June 30th, comparing 2021 to 2022, their overall revenue is down from 155 million to 147 million. That ain't that good. It looks like Honest really benefited from, the lockdowns. I believe it was like sanitation products. They had a huge boost in sales. And then once the pandemic started to abate, those sales collapsed, and that really hurt their revenue. So, I mean, if you look at their revenue growth, comparing the 6 months this year versus last year, let's see what that is. Down 5%. Okay. So they're showing this year over year. Oh, year over year for the 3 months, we're up 5%. But overall, they're down 5%. Oh, if you look at the 6 month window. All right, let's see what their gross profit was or is for this year. 7212, 30%. And then the 6 months for the year prior is 35%. So their gross profit has declined. Their revenue has declined. That's not very good. The only encouraging signs are selling and admin costs have gone down. Marketing has gone down a little bit. They said they were spending 15% of their revenue on marketing. Let's see if their math was correct. 17%, actually, almost 18%. And the year prior, they spent 30%. Holy freaking crap. So they've cut marketing as a percentage of revenues a little bit. R&D is down. No, sorry. That's marketing. R&D is basically flat. Total operating expenses are down. Operating loss is up. They had a bigger loss than the last year. And their net loss is roughly the same. So their total bottom line margin for these 6 months is 24,639 divided by 147,212. Negative 16% loss for the 6 months ended June 30th. All right, let's look at the balance sheet. Cash went down by about 10 million. Short-term investments went down by almost 20 million. Accounts receivables up. Inventories up. So inventory starting to stack up. I don't know if that's just a one-time thing or if their inventory is starting to build up and they're slowing sales down. Prepaid expenses are flat. Operating lease right of use asset. So in accounting, when you have a lease, you actually have to capitalize it on your income statement. And then you have to reflect that as a liability as well. Let's see. PP&E. Wow. I don't know if this is from depreciation or what, but their property, plant, equipment has drastically decreased. They had PP&E of 52 million at the end of last year, and now they have 14 million. Unless they have stuff that they depreciate that has a really short life, they really got rid of a lot of PP&E. That's something that I would be curious about. Let's see what they did. Purchases of property, plant, and equipment. It must be from depreciation. That's a pretty drastic decrease in property, plant, and equipment. Okay, so they had maturities of short-term investments, purchases of short-term investments. Yeah, I mean, it must have been from depreciation. Wow, they're going to have to replace a lot of their PP&E pretty quickly then. Holy freaking crap. Do they have depreciation expense broken up here? Let's see if that's an add back. Depreciation, amortization. That's really weird. Maybe they reclassify them as operating lease right of use asset. This is so freaking weird. I don't understand what's going on here. I didn't see them sell any PP&E. They actually bought some. It's almost like they had to change the accounting of some of their property, plant, and equipment and spread it between operating lease and property, plant, and equipment, because you can see this drastic decrease. That's weird. That's something you want to look into. But I suspect they just had to reclassify some of their PP&E as operating leases. I guess. That's weird. All right. So total assets have decreased. So you've lost equity there. Let's see. Total current liabilities are up. So less assets, more current liabilities. Let's see. Current ratio, good. I mean, basically, it's almost 4. And total liabilities have increased. And then we have an accumulated deficit. So their total cumulative losses to date are $415 million. I'll say that again. This company has lost a total of $415 million in losses since inception. All right. Then we go back to the statement of cash flows. Let's see. Negative operating cash flows. They're still burning about, let's see. How much cash are they burning? 25402 divided by 6. They're roughly burning $4.2 million in cash every single month. At least that's what they did over the last 6 months. If you go back and look at their current assets, even then they're going to be fine. They're not going to go out of business, but they're still burning cash. They're making no money from their operations, so they're going to have to raise the cash elsewhere. Okay. Their investing activities are just buying and selling short-term investments is where they're like parking cash. They bought a little bit of PP&E. They didn't sell any. That was weird. And they got a little bit of money from stock options exercises, stock purchase plan. Really nothing crazy, okay? But overall, they burned about $10 million of cash, when you add everything up, all the inflows and outflows. So at the end of the day, I still don't like this company. I don't understand. Like there's massive competition. The revenue growth is trash, 5%, year over year for the 3 months. But if you look at the 6 months, it's actually down 5%. Their gross margin has decreased. They're getting hammered by inflation and probably competition too. And they're just unprofitable. I mean, I don't know what to say. Jeez. Let's see. How many stock? Let's see how much dilution they've done in 6 months. 92.4 divided by 91.5. 1% share dilution. I mean, I guess that's not horrible, but that adds up to almost 2% per year. I guess that's not the end of the world. So overall, I mean, nothing crazy, like no bombshells, nothing to say this company's going to go out of business. And I don't think it's going to go out of business anytime soon. I can tell you that. But that revenue growth is not impressive. It's actually garbage. Actually, total freaking garbage. Let's do some questions. Spry Attack. That's right. Go get yourself a pair of pants. Should have bought Tesla. Yeah, okay. Honest crushed. They're unprofitable. They burned $25 million of cash over the last 6 months. Their gross margin is down year over year. Like, wow. But here's the bull thesis, ladies and gentlemen. Jessica Alba is hot. She's hot, bro. Buy the stock. VT's doing pretty good recently, man. You see VT go up 2%. That's a good day. I'd rather cut off my you-know-what and feed them to an orphanage than honest my bonus. Yep, that's honestly, I think that's part of his bull thesis. Let's see. Thanks for your advice on the book, Strongman. I saw my investment account increased by 4% by investing in index. You could have bought Tesla, bro. You could have increased by 1,000%. Index funds are boring. Thanks for buying the book. That's sold DD. She is indeed quite solid DD. Joe Biden is the reason. Yes, 100%. Jeremy needs honest tissues to gently wipe his tears away. I mean, I don't think the stock dumped, but if you look at the performance, it's down like 80% since it IPO'd. God. And he's been buying the whole way. Had a baby and people gave us lots of honest products. They're becoming more popular. Yeah, until you have to go buy them yourself, and they're more expensive than everything else. Let's see. I'm probably surviving off PPP money. Let's see. Jeremy outperforming VT. Please, please, please somebody verify that because I don't see it. Oh, man, strong man. It's over for you. Honest is up more today than VT all year. Jeremy's a genius. He'll get his own wiki page and all his picks and a nude Jessica Alba eating tattooed chef. So that's it. I mean, just looking at the financials, and then you just think about the company as a whole. The whole thesis behind this investment is like, oh, people are going to like these new liberal products because they're like clean or something. I mean, at the end of the day, I think people vote with their wallets. I've noticed Lufufu invests in a lot of like very liberal-oriented stocks. Have you noticed that? Like, he's in this like liberal bubble, and like he'll see things in his local Target. He's like, wow, there's a lot of stuff in this Target. That must mean everybody in the United States has the same thing. And he doesn't realize there's like other parts of the country, like Virginia, where we don't care about. Well, I guess there are some liberal douchebags here. We're a blue state, but we don't care about that kind of crap. Yeah, Jeremy knows his he knows he's got a nice feminine side. I'll give him that. Let's see how Lufufu spends revenue growth. Yeah, year over year for the 3 months, it's up 5%. But for the 6 months, it's down 5%. So I actually don't think he's a Democrat. Weirdly enough, I don't think he is. Have you done a valuation on Microsoft? I don't care about Microsoft. It's already in VT. All right, guys, that's it. Don't forget to check out today's sponsor, Sprytac.com. Delicious, durable, and comfortable cargo pants. You guys have a wonderful day.